Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all that corporate jargon. And today we're diving into Consumer Portfolio Services Inc., or CPSS as they're known on the stock market. Their latest quarterly report, the 10Q, is packed with numbers and we're here to decode it for you. Get ready because things are looking a bit mixed. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below, so consider joining us there for even more discussions. Alright, let's jump right into the thick of it with the company's financial statements. Looking at their balance sheet as of June 30th, 2025, compared to the end of last year, we see some interesting shifts. Their total assets have grown to over $3.7 billion. That's up from about $3.4 billion. This growth is mainly driven by their finance receivables measured at fair value, which have increased to over $3.5 billion from about $3.3 billion. This growth is mainly driven by their finance receivables measured at fair value, which have increased to over $3.5 billion from about $3.3 billion. This tells us they are acquiring and holding more loans on their books. On the other side of the coin, their total liabilities have also increased to over $3.4 billion from around $3.2 billion. This is largely due to an increase in their securitization trust debt, which is now over $2.8 billion, up significantly from almost $2.6 billion. This means the company is taking on more debt to fund its operations and loan purchases. Now let's talk about how the company is performing in terms of making money. We're gonna look at their statement of operations. For the 3 months at the end of June 2025, revenues were almost $110 million. That's a good jump from about $96 million in the same period last year. A big part of this increase comes from higher interest income, which went up from about $88 million to over $105 million. This is directly tied to that larger loan portfolio we saw in their balance sheet. However, this increased revenue comes with a higher cost. Interest expense jumped significantly to almost $59 million from about $47 million in the prior year. This is because the company is borrowing more money to grow its business, and interest rates have also played a role. Despite the higher expenses, their income before taxes still increased slightly to just under $7 million from about $6.7 million. And ultimately, their net income for the quarter was about $4.8 million, up from about $4.7 million in the previous year. So a small win there with higher revenue, even with the increased costs. Looking at the first 6 months of 2025, net income was about $9.5 million, a slight increase from $9.3 million in the same period last year. Again, revenues are up, driven by that larger loan portfolio and increased interest income, but so are expenses, primarily interest expenses. Let's dig into the cash flow side of things. For the first half of 2025, operating activities brought in over $128 million. This is a nice increase from about $96 million in the first half of 2024. Most of this cash is generated from the company's core business of originating and servicing loans. However, when we look at investing activities, we see they used over $360 million in the first half of 2025 compared to about $317 million in the same period last year. This is mainly because they are putting more money into purchasing finance receivables loans. Financing activities reflect how they fund these investments. They brought in over $255 million from financing in the first half of 2025, down from over $300. This shows they are using less new debt overall compared to last year, although they are still heavily reliant on securitization trust debt and warehouse lines of credit. Let's quickly look at their shareholders' equity section. The number of common shares outstanding has increased to over 22 million from about 21 million shares at the end of last year. This is due to shares issued from stock options and warrants being exercised, which is a common occurrence as their stock price movements make these options more valuable. The company did record stock-based compensation costs totaling about $1.4 million for the first 6 months of the year, which is a slight decrease from the prior year. This is how they compensate some employees with stock options. Looking at how they manage potential loan losses for their older portfolio of loans, that's the one not measured at fair value, the allowance for credit losses has decreased significantly. It's down to $145,000 from over $400,000 at the end of last year. For the 6 months, they actually reduced the provision for credit losses by $1.8 million. This suggests they feel more confident about collecting these older debts or have written off more of the bad ones already. For their newer loans measured at fair value, they actually factor in expected credit losses when determining the loan's value and interest income. So there's no separate provision for those. Now let's talk about their debt, which is a really important part of their business model. As of June 30th, 2025, their securitization trust debt is a massive over $2.8 billion as of June 30th, 25. This is up from close to $2.6 billion at the end of last year. This debt is essentially the money they borrow by selling pools of their auto loans to special entities. They also have warehouse lines of credit, which are short-term loans, to buy more car loans, totaling almost $400 million, down slightly from over $410 million at the end of last year. And as we saw in the income statement, this debt comes with significant interest expense. For the 6 months ending June 2025, interest expense was over $113 million. A big chunk of that, over $90 million, is on their securitization trust debt. This heavy reliance on debt and the cost of borrowing is a key metric to watch. The net interest spread, the difference between what they earn on loans and what they pay on debt, is around 5.2% for the first half of 2025. This is down from 5.5% in the same period last year, indicating that their borrowing costs are rising faster than their loan earnings. Let's look at how their borrowers are paying their loans. But 11.35% of their serviced loans were past due by more than 30 days as of June 30, 2025. This is up from about 10.87% at the end of last year. When you include loans that are in repossession, that percentage goes up to over 14% from about 13% at the end of last year. This increase in late payments and repossessions is a sign that some of their customers might be struggling financially, which could impact future earnings. On the bright side, their net charge-off rate, the percentage of loans they consider uncollectible, has actually slightly improved. The annualized net charge-offs as a percentage of their average servicing portfolio was about 7.45% for the first half of 2025, down from about 7.62% for the full year 2024. This could be due to better collections on repossessed vehicles or more aggressive write-offs of bad loans. The company also disclosed ongoing legal matters. In one case, a class action lawsuit related to deficiency notices for repossessed vehicles is still in play with an appeal filed. While the company believes the outcome of these legal proceedings will not materially affect their financial condition, they do estimate potential losses in the range of up to $3.2 million. This is a relatively small amount compared to their overall business, but legal battles can always be unpredictable. The report also reiterates the significant risk associated with their substantial indebtedness. They carry over $3.3 billion in debt. This heavy debt load makes them more vulnerable to economic downturns and limits their financial flexibility. While they believe they can manage this debt, the risk of not being able to pay it back is always present and could have a material adverse effect on the company. In terms of stock activity, they repurchased about 77,000 shares in June 2025. As part of their ongoing share repurchase program. This is a relatively small amount and shows they are still confident enough in their stock to buy it back. Overall, Consumer Portfolio Services Inc. is showing growth in its loan portfolio and revenues. However, this growth is funded by substantial debt and the costs associated with that debt are increasing. Their loan portfolio is showing some signs of stress with rising delinquencies, which is something to monitor closely, especially given the subprime nature of many of their loans. On the positive side, their charge-off rates have slightly improved and the company seems to be managing its legacy loan book effectively. The company's strategy relies heavily on securitization and warehouse financing, making them susceptible to changes in interest rates and credit market conditions. So what's my take? CPSS is playing a high-stakes game. They're growing, but loads of debt mean they are walking a tightrope. If interest rates keep climbing or if delinquencies continue to rise, it could really squeeze their profits. But if they can manage these risks and collections stay strong, they could continue to grow. The key here is prudent management of that massive debt load and keeping a close eye on borrower behavior. Alright, that's our breakdown of CPSS's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And don't forget to check out the Discord in the description. Thanks for watching. See you next time.